Welcome, everyone. Today, my guest is Lead Analyst Logan Mohtashami to talk about the jobs report, mortgage rates, and the failure of Silicon Valley Bank. Logan, welcome back to the podcast on this momentous day.
It is a very, very crazy Friday morning. And when this podcast comes out on Monday, we don't know what the Monday morning news will be. But yes, crazy day, crazy week altogether.
We knew we were going to have a crazy week. We had a lot of economic data coming out, and we knew today, especially, we were going to have the jobs data. But I think that the wild card there was Silicon Valley Bank. Walk us through that, or give us your 10,000-foot view on that.
So my first thought always is that President of the San Francisco Fed, Mary Daly, this is a bank in your district, and you're kind of just, hey, we're going to hike rates, we're going to hike rates, we're going to hike rates, we're not breaking anything. That is a bank in your neighborhood that went into receivership. And with the commercial loans that are out there and potential risks to some other banks, I think the Federal Reserve needs to just look at themselves in the mirror and think, what was our original game plan? What did we talk about stress? And if something like this pops up more and more, what are we going to do about it? Because if it is just putting your head down and go, well, we don't want 1970s entrenched inflation, and I'm saying 1970s because this is what they use, hopefully that was a wake-up call. Because I remember last year, when we talked about that the UK's pension system almost went under, right? Pretty big deal. The Bank of Japan was, doing interventions. The IMF was telling the world, hey, listen, stop raising rates. Sometimes when the dollar gets too strong, bad things happen. When it gets super strong, more chaos happens. So the dollar's been getting stronger lately. The Fed funds rate was being pushed to neutral rate. And then within 24 or 48 hours, we have a bank go under. So just hopefully just a wake-up call, land the plane. Don't crash it. Land it, right? You had your original plan. While some might think it was aggressive, your original plan was to follow 3, 6, 12-month core PCE. Because in reality, for anybody who follows the Fed, you don't believe in the 70s inflation, neither does the bond market. So stop acting like it is. Okay? It's you have to endure and not overplay the hand. So hopefully after this weekend, there's a little bit of more common sense now that not everything can go smoothly when you front load massive rate hikes into a system that has not seen it, not only here, but around the world in a very long time. So just a little bit more mindful going out in the future.
Appreciate that. Of course, we're seeing a ton of people, chiming in like, oh, this is 2008 all over again. We're about to see bank runs on all these different regional banks, But I do think that Silicon Valley Bank was a very specific case. Is that your feeling as well?
The capital leverage ratio laws that were changed right before the crisis that, like Bear Stearns took on, where you could be leveraged 40 to 1 and now, from 10 to 1. Those things aren't here, but regional banks, and what we have to look at is commercial loans going out in the future and how much losses are marked. I mean, I don't want to get too technical, but how much losses can you actually put on the books? And it just, it is so frustrating. You are playing with fire that you don't need to. You are almost done. And there's a part of me that just sits there and thinks, I hope President Mary Daly can just go into the bank and say, oops, maybe I missed this one. That was in your corner of your neighborhood. That happened right underneath your watch. And the first thing I tweeted last night when all this was going, or yesterday, was that San Francisco Fed has got some work to do, right? So it is so frustrating as somebody who's not a Fed pivot person, because I thought that was their original plan was fine if you wanted to stick to it. But now they're doing the things that people have always said about the Federal Reserve. And what is it, Sarah Wheeler?
Yeah, old and slow.
They are old and they are slow. And right in front of them, boom, you lost one of your banks. So recheck, talk to all your banks, figure out what losses are going to come, and then look forward, especially on the commercial loan side of the equation. And if there's any other possible run on the banks in the future that are smaller regionals. But I think it was, I think if this didn't wake up the Federal Reserve to be a little bit more mindful and not so arrogant, then I don't know what will. So I think the long end of the bond market has been saying this story for some time. And hopefully this is a good learning lesson for the Federal Reserve.
Well, let's go on to jobs, because it is Jobs Friday, and it's Jobs Friday even a week late because, it's March 10th. So tell us what we found and whether you were surprised or how you felt about this jobs report.
So I know a lot of people, at least what I saw on the internet, said, well, the job numbers are going to come in bad, seasonality. And a lot of smart people actually took this stance. I'm just going to leave this talking point here for everyone to remember, because it's a talking point of mine going back to the COVID-19 recovery. And in the article that came out on Friday, you see it. We are still in makeup mode, right? And the reason why the job numbers are still really good is, unlike 2010 to 2016, where we had a very weak recovery and population growth for a prime age labor force peaked in 2007, declined, and then was slowly working itself back. We don't have that here. So the civilian labor force before this jobs report was about 166 million. If you take February of 2020 data, we had over 152 million jobs were created, 200,000 on average. If that just goes in without a COVID-19 delay, you're at 158 to 159 million jobs. That's where we should be. So some of the sectors are not, they need labor because the demand never really broke. So this is why I've always said job openings, 10 million early in the recovery, right? We're going to get all the jobs we recovered back by September of 2022. And now it's a makeup mode. Now it's really, what areas of demand that gets hit. Now we saw jobs being lost in transportation and in the technology and information industry. Those are places that we've seen the layoffs being called upon. But just remember going out that we're still in makeup mode, and eventually in time, we're going to go back to our slow job growth because population growth is slowing, but we're not anywhere near where we could have been if there was no COVID. So if people are surprised how many jobs we created last year and so far the prints this year, think of the jobs numbers like this. And until jobless claims rise or job openings noticeably fall down, the growth rate is slowing down. I think the bond market just reacted right away because wage growth is the month-to-month data was cooling down. The labor force picked up. So how did the unemployment rate jump up with jobs being created? Labor force picks up, right? Prime age labor force growth picked up noticeably. We're back to pre-pandemic highs. So the difference with the United States of America is that, and by the way, all the trolling Twitter accounts that say we're Japan, we are not Japan. Anybody that could read the census data correctly would know this. So anybody that says we're Japan cannot read. Simply, second grade education, visually see. We have a massive young workforce that replace people, right? Germany doesn't have it. Europe doesn't have it. China doesn't have it. Japan doesn't have it. So we have a little bit better replacement buyers. This is why I talk about years 2020 to 2024 have replacement buyers, replacement consumers. So if the trend of job openings goes, in this case, the COVID-19 was going to create that gap. It looks normal. So if people are confused because you have people running around the internet and some Wall Street analyst who says, oh, the demographics of America are terrible. No, they're not. No, they're not. This is our American muscle. This was always we own the world here, right? Because of this, because we have young workers. Now, over time, baby boomers will all move out. They'll get replaced. And then, Gen Z has to step up at that point. But if you look at it in that context, the job growth numbers look relatively where they should be. It's just there's going to be a time where demand gets hit enough to slow that process down to that 158 to 159 million. But hopefully that explanation and the charts that I put into the article explains why I was the only person on planet Earth that talked about job openings getting to 10 million. Hate the job openings data all you want. I know there's a lot of people who hate it, but it happened, right? And the job growth is still in makeup mode. It happened twice. Now, over the last COVID-19 recovery, I just want to see anybody else who talked about this early on and now the second tier recovery model, because people are starting to use birth death models and all this stuff. No, just keep it simple. Take the pre-trend and go with it, because we are not Japan. We are not Germany. We are not, China, where their population growth prime age peaked. We are the United States of America. It's different here.
It is different here. It's confusing because we had this positive jobs report, but bond yields really aren't acting like you would not you would, but like most people would expect them to do in light of that. Now we do have some other things going on, but even Thursday night, you and I were having a conversation about how you thought mortgage rates would react. So walk us through that. Why are those two things in conflict?
I am so sympathetic to my crazy bearish market friends who are just, the 10-year yield's going to go to 5% and the Fed funds rate, the short-term rates are pricing in a higher Fed funds rate for longer. I totally get that. If this was the 1970s, you could have a case.
So you're not actually sympathetic. Let's
I
just make
listen.
sure you are not sympathetic.
I'm an agent of chaos, Sarah, and all agents of chaos want war, because this is where we perform the best. This is why I want live debates with people, because you don't want to take people out in darkness. You want to take them out in front of everyone. In any case, the 10-year yield, for those that follow the tracker, right? We created those black lines for a reason. Down there, the Gandalf, you shall not pass. We tried to break below that. We did 3 or 4 times, intraday, and it reversed, right? Because bond trading or money or quants, whatever we want to think about it, if something doesn't break, they're going to go the other way. Here is the other case. We're sitting here 2 weeks. We haven't been able to break above this level, and we had hawkish Fed, take back Fed, job openings data solid, nothing great, but slowing down. And then we had a big jobs report, and immediately that range reversed. Now, I would also say there was a lot of people short the bond market, which means they were betting on bond yields going up. Again, I'm sympathetic to that view. I understand, but why are middle-aged stock traders always thinking that homeowners are going to rush to sell their homes? Because they are on leverage, right? And they're fragile. So when things don't go their way, they immediately cut and run. American homeowners do not operate that way, right? So this world that's clashing with each other is just different. So you can see what happened. People that were short the bond market just gave up, and then it's reversed quickly. So we're just, again, in that range we talked about in the 2023 forecast, what we talked about every single week now on the tracker. And we're just going to take it from there and see what happens with the economic data. And if you look at it in that context, and if you read the 2023 forecast, it looks perfectly normal, right? In that context. So we didn't test 4.25%, the high level. We didn't test 7.25% on mortgage rates. I think we got to 409 on the 10-year and was 710 on the 7.10 on the mortgage rate. But rates fell back down again. We're well under 7, and the 10-year yield reversed. And just think of it as bond market channels, and that's it. And hopefully people can understand that the long end of the bond market does not agree with the short end, and they haven't for some time now. So the inverted yield curve is so inverted. In fact, the three-month 10-year inversion could get 150 basis points inverted, which historically is crazy, So there's just this war going between the long and short end. It's like one of these Netflix Married at First Sight shows. You get married and you're just like, you're now spending your first day with your wife or husband, and you realize, this is not working, right? So the short and the bond end are just, they're hashing it out. And for now, I mean, even the short end of the bond, I mean, the 2-year yield just collapsed. And I think that's more due to the banking situation. So the question now going forward, have we now added a new variable into the equation? Do we talk about this in the weekly tracker where, boy, now we have to worry about, is the banking system as solid as it is? And will this change the Fed? Because the kind of running joke is the Fed will hike rates until something breaks. Well, something broke. And Mary Daly, the president of the San Francisco Fed, that's in your neighborhood. And I just, again, for me, it's like the Fed had a plan. They told everybody the plan. Everyone went with it. And then all of a sudden, they're starting to change things, and the market does not know what to make of it. And we've already lost one bank because of market stress.
Hi, this is Diego Sanchez, COO of HW Media, and I'm joined today by Alex Ilazai, Chief Strategy Officer at United Wholesale Mortgage. Thanks for joining us today, Alex.
Hey, Diego. Thanks for having me. Good to be here.
So diving right in, we might be seeing the first glimmers of a rebound in the housing market. How is this playing out in the broker channel?
It's playing out really well, so we're excited about 2023. We see a lot of optimism in the market, just like we in 2022 and leading into Q4, and we're hitting the ground running really fast in 2023 here in Q1. We're excited about this whole year and what's upcoming. We've launched a lot of new products. We continue to see a lot of optimism in the broker channel overall. And obviously, when we're in a purchase market as we're in right now, that's where brokers really thrive in the more complex transactions with buyers and sellers and agents and a lot more going on. Just brokers are the best place for consumer to get a loan. So we see a lot of them continue to grow and thrive.
Digging in a little more there, most forecasters are seeing rates in the 5s and the 6s for 2023 and 2024, which means we will be in a purchase market for the foreseeable future. Is this good for the broker channel?
Yeah, it's great for the broker channel. Like I just mentioned, just assume a rate's at 6%, right? We have temporary buy down products, just as an example, where you can buy down that product where the first year you're going to pay 4%, second year you're going to pay 5%, third year and beyond you'll pay the 6%. And by that time, hopefully we'll be in a position where we can refi that loan. So really, there's just so much opportunity. To me, the way that we think about it, Diego, is like you're dating the rate, but you're marrying the house, right? So you want to go out there, if you see the house that you like, you see the property you like, you buy it, right? And you worry about getting that lower rate maybe in a back half of the year or even next year. But again, it's just going to be a short-term thing the way that we think about it. And still, relatively speaking, we're not talking about massive interest rates, right? I mean, the days of the 2s and the 3s that we were experiencing in 2021, that was somewhat of an anomaly. So we expect them to come down a little bit, and all the forecasters and economic indicators are pointing that fashion. But right now, I think we're in a good spot, and brokers are continuing to win. And you can see it in our broker share and everything that we're doing. We're just having an outstanding start to the year.
Yeah, I mean, the broker channel's had a great couple of years of growth. Do you expect that growth to continue in 23?
Yeah, we do. I mean, as you mentioned, in the third quarter, which was the latest quarter, actually fourth quarter, is about 22.5% or so of the market is broker now, which is, I think, at the highest since 2009. So we're continuing to see great trends in the overall growth of the channel. And we expect it to be 33% by 2025-26. Like that's what we're expecting to see the numbers come in at. And a lot of that is being driven by just literally hundreds of retail loan officers that are leaving retail and joining wholesale every single month. So those numbers are continuing to do great. And we're actually seeing it as another example, Diego, at UWM here. We have about 400 to 500 loan officers that come in every single week for Success Track, which is a great opportunity for them to learn, develop, network, and help grow the overall broker channel together. So you're seeing a couple thousand people a month that are coming in, and that was happening in all of last year, right? And all the years, several years before that when we started. But if you think about like the times that we're in, right? Everybody talks about a lot of the negativity, and that's what the usual focus of. But the reality is, people are excited about it. Brokers are excited about it. The market's growing. And at UWM, obviously being 100% wholesale, no other company in the mortgage space is better positioned than we are.
I love seeing the confidence and the leaning in that's happening at UWM. Alex, thanks so much for joining us today and sharing your insights.
Great. Thank you. It's good to spend time with you.
So I try to do this every time we talk because a lot of our audience, they're out there, they're trying to make their business work in this environment. And the bottom line for them is like, where are mortgage rates going? Where are they right now? Where are they going? And I mean, this has even changed significantly since the last time you and I talked.
Yes, but I would argue that the 2023 forecast and the weekly tracker has correctly talked about this range, and the inflection points have now bounced off each other twice. So we're in their same range. Now, again, if the labor market was breaking, now jobless claims did rise noticeably this week, but some of that I think is seasonality of school teachers. But if that starts to pick up, right, you got a different story then. We're not there yet. That's why I'm not a Fed pivot person. When jobless claims starts to really noticeably break, the bond market, who already does not agree with the Federal Reserve, is going to go the other way. And they're going to go, honey, you either are coming with me on this vacation or I'm leaving you behind. Okay. So we're not at that point. Job openings are still high. Claims are still low. But again, rate of change, and we'll take it 1 week at a time. That's why we created the tracker, right? I encourage everyone, go read the 2023 forecast and look at the tracker. These ranges are here and they bounced off each other. And it's trust me, it is crazy to try to channel bond markets. But, I would argue, take my work in the previous expansion during COVID, making adjustments. Of course, 2022 was different. Everything flipped and turned around the world with the Federal Reserve and other things. But so far this year looks about right. So we want to add new variables into the equation if we see that, and we do have one. Concerned about the banking system now, other regional banks, if this happens. So we'll see how we'll take it 1 week at a time. Again, this is Friday that we're talking. Monday we might have a totally different story out there, but yeah, that it was a crazy week. I know a lot of people thought mortgage rates had to blow up higher and the 10-year yield was going to blow up. I'm sympathetic to that view, but there's a fight between the long end and the short end, and eventually over time the long end wins always.
Spoiler alert, you are not sympathetic to that view in any way. Remind us again, what is the range for mortgage rates that was in your 2023 forecast?
So assuming the spreads are very wide, 3.21% on the downside and 4.25% on the upside. And then we have that
for the mortgage rates
for the 10-year yield. That's a 10-year. I work on 10-year yields first. So on mortgage rates, 5.75% to 7.25% is that range. If the spreads were better, you could possibly get down to 5.25% in that kind of environment. We're not there yet, but if the jobless claims data starts to noticeably get worse, we can break below 3.21, get below 3%, and if the spreads get better, we are below 5%. We have a 4 handle on mortgage rates. But it's interesting that a few weeks ago, Neil Kashkari talked about the Minnesota Federal Reserve member, and he said, mortgage rates being down, people buying home, that's not good. That makes our job harder. So we're dealing with a Fed that I mean, part of me just says they're just talking. I mean, we talk about this all the time. They're just talking tough. But what if I'm wrong? What if they really do believe they're in the 70s? I mean, that's crazy. I mean, the core PCE would be taking off. Rent inflation would be taking off. These things are all falling, which is common with global pandemic. So again, we'll see. But I think a good wake up call for the Federal Reserve, and I'm curious to see what President Mary Daly says, the San Francisco Fed, after she lost one of her biggest banks in her neighborhood, right underneath her watch.
Huge deal. I mean, huge deal. And people are worried, and people are worried about what that means for a lot of companies who ran their payroll through there, or that's their bank, and these are some of the companies that we all rely on. So it's interesting.
When you front load rate hikes and the bond market acts crazy, things happen. We saw that last year with the UK, with the Bank of Japan, with the IMF. The dollar is getting too strong. Dollar calmed down. Dollar started to get strong again. We talked about the last podcast. And just hopefully, again, we want to land the plane, not crash it.
So, a big part of the tracker is the mortgage rates, because obviously that's, the housing is most sensitive to mortgage rates. Even if you don't believe in the mortgage rate lockdown theory, we do know that if you're in business of mortgage and real estate, rates are hugely important, right? So that's one part of it. The other part is inventory. And you always get the Altos research data on the weekend before it's published. So tell us what you're thinking, because we keep waiting for when is that going to break out for spring?
When we start to get lower and lower numbers of inventory falling, we'll get the eventual seasonal increase. But as we can see, new listings data lowest ever. I've had a very fun week on Twitter where people are talking about always these mass inventory spikes, and I said, listen, guys, I held my ground on COVID. I held my ground on forbearance. I held my ground on 7% mortgage rates and the biggest collapse in sales. And the new listings data the last week before was the lowest levels ever. So you have to like humor me why I should listen to any of you. Okay? Because you had everything you wanted. You had a global pandemic, you had forbearance, and you had the biggest crash in sales, and we had the lowest new listings print ever recorded in history. So why would I listen to a group of people that have talked about for 11 years of the inventory spike? Because you're not housing people. You're never housing people. And I could tell this by the way you talk. And there's a reason why you're not housing, because none of you forecast anything. And when you don't forecast anything, you just make stuff up for attention. And that's what's always, this is my thing. I want to challenge every human being on planet Earth on housing economic discussion, but I need you to come on camera so I can show your family members, your coworkers, your neighbors, how much of a housing expert you are, because don't forecast anything. And when you don't forecast, you don't hold yourself accountable for wrong takes. So we're sitting here. Seasonal inventory is bottoming out later. We've talked about that. We've written about that why, but why is new listings? So I think the big thing I talked about on Twitter this week is investor demand has collapsed year over year. So under that was the big premise, that as soon as investors collapse, they're all going to run to the hills, or everyone's going to list their homes. And I said, that's kind of not how housing works unless you're leveraged up, stock traders. And flippers typically don't hold their properties for very long. So when rates rose, like we saw in 2018, their demand fell down, which means they have less property to flip. So you're thinking that flippers were buying all these homes for 10 years, and then all of a sudden they were all going to run to the market and sell. No, they don't hold product for a very long time. Their job is to buy something cheap, fix it up, and flip it as soon as you can. They're not long-term holders. So that, I think, was the confusion, because again, on Twitter, I could take on stock traders on this. And that was the premise, that or the vacant homes. The vacant homes is the other one. Like, we've had millions of vacant homes for years, and everybody keeps on saying, if just 10% of these homes come to the market, that's like 6 million homes. I'm like, oh God. Just look at how inventory channels have worked for 4 decades. Work off of that. Make a hypothetical theory based on that, not this rich people with 2 to 3 homes are so broke that they're going to rush to the market. And it's so tiring. It's just like, why are you like this? And Sarah Wheeler, we've always said, some people always like to ice skate uphill. It's just they are born into bondage this way, and they've lived their lives always this way, and they will die this way. And in the afterlife, they will walk the world with no ears, no eyes, no tongue, screaming about the Fed's balance sheet and how living on planet Earth after 1913 was so detrimental to them, that I will do what I can to create a time machine. And when I do, I will send you all back to the 1800s, and you could enjoy a century without the Federal Reserve as being part of the process. And you will live in peace, even though you couldn't last 10 minutes in the 1800s. Life was so much tougher back then than it is now.
Yes. Okay. Well, speaking of vacant homes, so you and I were at a conference in New England where we met a gentleman who said that this was going to, he was talking to us, and he was like, this is what's going to change the housing market, is all these vacant homes that are, especially, he wasn't talking about investor homes or people who have 2 or 3 homes. He was talking about the stock of homes that are vacant because, they're just like, they're not very good homes. It's like, but those homes, I mean, a lot of them are vacant for a reason. They would not pass down, that you can't fix them up from where they are. They're in the middle of nowhere. They're not, they're not connected to anything. And we were both like, I don't think that's what you think.
Listen,
it is.
We've had millions and millions of vacant homes for years. And the simple answer is, your hypothetical theories don't work because they're not active listings. So you have to create a model that says, why all of a sudden will all these vacant homes be ready to sell as a primary resident property? And are these areas that people want to move in? So, and some of them are in such legal limbo, they can't even do it even if they wanted to. So It is what it is. I've dealt with this clan for over 10 years, and they just won't quit. And other people have caught on to this act. That's why I challenge people in live debates. Sarah, we've only got one person to take me on live. I do this all the time. I'm on Twitter. Twitter is the pit of hell, challenging people to live debates all the time. I did it like 7 times this last week. I said, just come on and let's go at it. And no, I don't want to, because I don't know what I'm talking about. And if I did, then my YouTube site might look fraudulent. Come on. So
I do think that the idea of active listings is one of those things that people don't, until it clicks in their mind. They're like, there's all these homes. It's like, yes, but these are not homes that are available to buy.
It's not even the vacant homes. It's the homes, total homes under, total homes per capita. That's the favorite trolling chart. That's where there's no shortage of homes. Look at the homes are rising. There's 144 million housing units out there, and I saw it again this week. It's funny. It's a clan. It's a 10, 11 year clan, and these are all anti-central bank people. And I want them all live on camera, but they keep on showing this chart. They keep on telling, oh my God, we're going to have housing bubble supply because of this number, and the exact opposite has happened in the last 10 years in the biggest fashion ever recorded in history. So I'm just assuming they don't believe this because no one's this bad. They're just trolling. But what if I'm wrong? What if they are this crazy? What if they can't read? What if my whole life, I've just assumed these people were just trolling people they don't believe this, but I could be wrong. They can be this bad. But if you come on HousingWire on a face-to-face live debate with me, and then I could take all your forecasts, which you've never done, look at all your models, which you don't have, then we can show the people of this country the light. Take the trolls out of the darkness and bring them into the light.
Yes, we could. So listen, anybody out there who wants to take on that challenge, let me know. Sarah at hwmedia.com or Logan at hwmedia.com. We will get you set up. We have not had any takers on that.
Because nobody forecasts. And these people hide behind fake names. And their YouTube sites are terrible. But if you get them in a live debate, you structurally force them to become men. And that's what we want to do. We want to make American men tough again. I never have to worry about women. Women are so much tougher than guys. Like, the women are just awesome. They're just, they don't waste their lives like, oh, the Fed. Okay, we got some crazy ones, but still, this is now COVID, forbearance, and the biggest collapse in sales, and 7% mortgage rates, and new listings data is at the lowest levels ever this last week. So something went wrong here. I know what it is. The question is, do you finally admit to people that I'm just making stuff up because I don't have a life and I just run around the internet and I just troll out, and I want people to listen to my YouTubes? And again, let's go. I'm here all day, 24/7. We're ready to play ball.
Okay, well, instead of listening to those people on Twitter, I encourage our listeners, many of whom already check out the housing market tracker on HousingWire. That comes out every Monday, and it goes over purchase apps, inventory, 10-year yield, and mortgage rates. Really interesting. And this week will be even more interesting because of some of the things happening right now. Logan, thank you so much for being on, and we'll talk to you again soon.
It is a pleasure to be here, Sarah Wheeler.
Glad to have you.